So the next topic that we are going to learn is ISA 250, consideration of laws and regulations in an audit of financial statements. Now, what does the standard says is, this is something that we have already learned in our AA subject in a brief manner, which is called as NOCLAR. So we would have touch based it very vaguely or very in a smaller way in AA. But what we have to learn in AAA is that what constitutes for NOCLAR, what do you mean by non-compliance, how do they affect the financial statement, what does the non-compliance or how do they affect the financial statement, what are the responsibilities of the management in relation to NOCLAR, what are the responsibilities of the auditor in relation to the NOCLAR. Various companies out there are required to lot of laws and regulations for any jurisdiction that they work for. So if a company is working in UK, there are various laws and regulations that they have to comply. If they are working in India, the Indian laws and regulations they have to comply, US laws and regulation, etc. If the company have branches in all these three, they have to comply with all the countries or all the jurisdictions laws and regulations. Now the laws and regulation very clearly says, right, that how the company can conduct the business, what are the conditions or provisions they need to have even before they start the business, how they have to formally follow the rules and regulation in order to sustain in their business. In fact, how do they affect the financial statement, how these laws and regulations affect their financial statements, etc. Now, the laws and regulations that the company are required to follow are divided broadly into 4 categories: company law, employment law, civil law, environmental and law and regulation. The company law is part of the Companies Act. Company law is part of the Companies Act of 2006. Companies Act of 2006. Now this Companies Act have direct impact on the financial statement, because as per the Companies Act, the company have to maintain certain disclosures, they have to record certain amounts, they have to prepare the financial statement in a specific form or content as required by the Companies Act. So hence, not following this Companies Act rule can have a direct effect on the financial statement. Others are majorly relating to the operational aspects, like how do they conduct the business, on what are the rules and regulations they have to follow to conduct the business, etc. Like civil law, they talk about the contract, like have they followed, there are specific conditions or criteria that are to be met in order for a contract. If they enter into a contract, they are supposed to fulfill the contract. If not, they are not following the civil law. Environmental and legal protection talks about the environmental footprint damages that the company creates and how to protect the environment within the jurisdiction of the country based on the damages caused by the company. Employment law talks about for the employees, to protect the employees of a company. These laws are established so that the company does not take undue influence on the employees. Like they cannot fire them without a legal cause or a cause of notion. They cannot fire the employees. They have to maintain a healthy environment for the employees to come and work. Their safety have to be taken care of. A lot of things. So what we are going to learn in this particular topic is definitely, firstly, what is non-compliance. So let's understand, what does non-compliance mean? So non-compliance means it refers to acts of omission or commission, intentional or unintentional, committed by the entity or on behalf of the entity by those charged with governments or by the management or by any employee who are working under the direction or supervision of the entity. So that is called as non-compliance. Non-compliance does not include any personal misconduct which are unrelated to the business activity. like for example, any employee does something illegal, then it is on him, on the employee. It should not be treated as, okay, it's the entity which made him do something illegal. Like let's say for example, he went to a bar and had few drinks and started fighting with the staff over there. That's upon him. The maximum thing the entity can do is to dismiss him from the company. So non-compliance is where the entity in their name or on behalf of the entity, their management does something illegal, which is not allowed as per the legal provisions of the laws and regulation, and that is in short form mentioned as non-compliance. So if the entity is not following the rules and regulations, it is referred to as NOCLAR. Now this NOCLAR have certain NOCLAR have direct effect on the financial statement. To give you an example, taxation law, Companies Act, they have direct effect on the financial statement. As I told you, the Companies Act specifically or very clearly says certain amounts or the disclosures that are required to be made in the financial statement. The Companies Act very clearly says what is allowed. To give you an example, depreciation. There are certain provisions in Companies Act that does not allow for you to do depreciation in a certain way or for a certain kind of assets. Now you're not allowed to do that, and that's very clear because Companies Act very clearly says that. So if you are not following that rule or regulation, then you will have a direct effect on the financial statement, because financial statement will be misstated because as per the Companies Act, you are not supposed to do this, but you still did it. To give an example, taxation. You're required to file income tax returns. You're required to submit the tax returns. You have to give the indirect tax as well amounts to the taxation authorities, etc. So you're not doing it, it will have a direct effect because the taxation amount which is representing in the financial statement will be incorrect. And company making a profit are supposed to pay tax. Even though they are making loss, they are supposed to give returns. Those are all will have direct effects on the financial statement. Others might not have direct effect but are required to comply to conduct a business. To give you an example, banks. You cannot open a bank in one day, like you open a normal shop, like you open a supermarket, or you can open a grocery shop in one or 2 days. It's very simple. You can open it very easily. But a bank, you cannot open like that. There are certain rules and regulation you need to follow, you need to comply in order for your business to conduct. Even restaurant, you cannot open restaurant in a short manner. You need to follow the health and safety regulation. You need to get approval of the specific regulations in order for you to even open a restaurant, and even you need to maintain certain things to conduct your business. If not, you will be closed down. Like in India, how many restaurants have been closed down because of a health and safety rule? They go and visit, and if the compliance is not correct, they just shut it down. So even those non-compliance, let's say for example, they are not following this rule, but that might not affect the financial statement because it's not affecting the amounts in the financial statement or disclosures, because the laws and regulation does not say you have to disclose these things in financial statement, or they does not say this is how you need to account it. They have nothing to do with the accounting, but it has something to do with the compliance. And if you're not following the compliance, definitely you will be asked to shut down. And if you are asked to shut down, then it automatically or indirectly affects the company's financial statement as going concern. The third aspect is operating aspects. Operating aspects is like operational safety, health, equal employment, employment law, etc. Like you need to comply with these rules if you want to operate it in a smooth manner. And these non-compliance will result in what? They result in fines. They result in penalties, fines or penalties. They could also result in, litigations. And if you are having fines or penalties, or if you are having litigation, they have to be reported in financial statement. Very simple. It has to be reported. You cannot say that, okay, I paid a fine and I'm not going to show it as an expense. You have to show it. Certain kind of non-compliance can also result in going concern, which could also affect your financial statement and have to be reported in the financial statement if you are having a doubt on the entity's going concern. So now let's learn what are the management's responsibility with respect to this NOCLAR. So management are the one who are conducting the entity's operations. Like they are the responsible party who are required to ensure that the business is conducted with applicable laws and regulations. So the managements have the responsibility for prevention and detection of non-compliance. So to ensure that they are fully complied with all the legal laws and regulations, they need to ensure that they prevent from for having a non-compliance hit. They need to also ensure that they detect such non-compliance as well through their regular operational aspects. So specifically to talk about, the management should formulate certain policies and procedures which will help them discharge its responsibilities for prevention and detection of non-compliance. What are they? Monitoring. Regular monitoring of new legal changes and ensure that those new changes have been implemented in the business. If there are new changes that have come up, then it has to be implemented in the business. Having strong internal control and systems. Like if there is any kind of non-compliance, the controls will identify that this is not complied with the system, because they will have proper systems, be it a manual system or be it an automated system. They need to have proper systems in place which will help identify the company that they are not following the regular laws and regulations very clearly or strictly. Developing and publishing of following code of conduct. How they need to conduct their business. They need to ensure that they develop it, publicize it among their employees and strictly follow it as well, and ensure that all their employees follow it as well. Give them proper trainings, understand them about these code of conduct, and if they are not following it, ensure that there is fines and penalties for the employees or even strict actions against them, etc. Monitoring a compliance with these code of conduct and appropriate disciplinary actions to the employees who fail to comply with it, as I already mentioned to you. In many companies or large companies, big MNCs, they will have something called as a compliance team itself. What their daily work is to ensure that they are every employees are following their compliance very strictly. When I was working in JP Morgan or Goldman Sachs, any company for that matter, the first thing the compliance team would do is give us a list of documents, ask us to read it and sign it, saying that that we as an employee understand the compliance requirements and strictly follow them. And this is what the compliance department used to do. They need to ensure that the code of conduct and the rules and regulations established for the company for their employees are strictly followed. They need to have, every company will need to have a legal advisors who will help to assist the monitoring of the legal requirements. So if there is any legal changes or any changes to the company's legal framework, the legal advisors will help them. Many big companies will have legal department as well, who will ensure that the legal side of it are taken care of for the companies. Maintaining a register of significant laws and regulations which the entity need to comply with. We used to have a separate team altogether where we list down all the laws and regulation and ensure that whether there are any changes, we keep updating the laws and regulation and ensure that those changes are being communicated to the employees as an email blast. And and this have to be followed by all the employees and see if within their department whether there is any changes in laws and whether the changes will affect their day-to-day operations, and that changes have to be inculcated. So on a nutshell, monitoring the legal requirements, developing and following a strict code of conduct, disciplinary actions to teams who fail to comply or employees who fail to comply with, etc., are the major responsibilities in relation to the prevention and detection of non-compliance. In larger entities, they will have a sizable number of employees which will help them to maintain these laws and regulations. Like entities will create separate departments like internal audit committee, compliance divisions to ensure that these policies and procedures are assigned and as well as followed by the day-to-day basis by the employees of the company. So as I told you, Separate departments are created to ensure that firstly, they create, like to give an example, compliance department. They create certain laws and regulations within the company and give it out to the handbook to the employees and ensure they follow it. Audit committee creates certain laws and regulations relating to the audits, as well as certain risk associated to it, various other Companies Act perspective, etc. Internal audit comes in and checks in each of the department whether they are able to detect any non-compliance and report it to the management as well. So that's what prevention for a compliance team and an audit team, audit committee team. Detection is again an internal audit function. Internal audit also reports to audit committee. So they also act as part of the detection of non-compliance as well. And you need to understand that the prevention as well as detection of non-compliance is the prima facie or primary responsibility of the management. So the prevention and detection of the non-compliance to laws and regulations strictly lies with the management and not with the auditor. So what does auditor do? Let's try to understand that. So as we discussed, a company is required to follow so many laws and regulations like companies law, employment law, environmental law, civil law, so many laws. And if there is financial institutions, in further laws they have to follow. So as an auditor, is our duty to ensure that the company is actually following all these laws and regulations? The answer is no. Because an auditor is being appointed by the shareholder on the subject matter to audit the subject matter, which is the financial statement. His responsibility is to ensure that the financial statement represents a true and fair picture. But if the company is not following the laws and regulation, it could have a direct effect on the financial statement. But it's not the responsibility of the auditor to ensure that the company prevents from doing some non-compliance. So prevention of non-compliance can never be the responsibility of an auditor. To a certain extent, yes, detection. Yes, detection can be part of the responsibility of the of the auditor, because non-compliance could lead to an effect on the financial statement, which we already learned when it comes to Companies Act or taxation, where there could be financial implications. So following these, non-following these laws and regulations could have a financial implication, as we discussed, fines or penalties. These fines or penalties will have financial implication, and if it is a material fine or penalty, it has to be disclosed properly and reported properly in the financial statements. If they are not doing it, then there is a risk of material misstatement. Litigation, it could lead to a certain litigation aspects, like not following the employee law and dismissing an employee, and he goes and files a legal case. It could come to us, rebound to the company as litigation, and if the litigation is not appropriately disclosed in the financial statement, again further there could be material misstatements in the financial statement. Going concern, if the bank is not following a rule and regulation properly, it could lead to them closing down their business, which could automatically give effect to the going concern. So hence, it is auditor's responsibility to ensure that any laws and regulation which have a direct and material effect on the financial statement, detection will be part of their responsibility, where they need to detect whether the company is doing certain non-compliance activities which could lead to the financial statement having a misstatement which is not properly being reported. So the auditor's responsibility cannot and will never be for preventing of the NOCLAR. Only the management is part of the prevention of the NOCLAR, similar to the internal controls. It is the management's responsibility to prevent any fraud or any error, but it's the auditor's responsibility to also to do some kind of detection. Now, as part of the risk assessment process, the auditor will consider the impact of any non-compliance on the financial statement and assess whether the financial statement could have a material misstatement. That's where he does a risk of material misstatement. And he should prepare certain procedures to respond to this risk of non-compliance. The risk could be that there could be a direct effect on determining the material amounts on the financial statement, such as tax laws that require the auditor to obtain evidence of compliance. So any laws that have a direct effect. So Any non-compliance that have direct effect on the financial statements, like tax laws or Companies Act, auditors are required to obtain evidence of compliance. So auditors, when they read the financial statement, they need to read it for whether the financial statement is following the rules and regulations of taxation, whether they are following the rules and regulations of Companies Act as well, because it is very required that they do so, because otherwise it have a direct effect on the financial statement, because Companies Act and the taxation provisions do mention what's supposed to be part of your financial statements. So anything that have a direct effect, like the taxation rules, the Companies Act rules, which will directly affect the financial statement, auditor needs to obtain direct evidence of compliance. Like they need to ensure that the entity is complying those direct affecting laws and regulations. Anything that does not have a direct effect but have a material effect, not direct but material effect, like operating aspects, like there is a huge penalty or huge fine, etc., then they need to undertake procedures in such a way that they identify non-compliance. Like the auditors will define certain procedures to ensure that, okay, whether there is any indication of non-compliance or not. To give you an example, when I was auditing, one thing we always do is to ask us list of fines and penalties the company have paid. We scrutinize the journal entries to see if there have been any fines or penalties paid. We check the bank statement to see if there is any fines and penalties which have been, directly paid to the government and whether they are reported correctly, etc. So those are called as non-compliance related procedures. Like if there is any material effect, then we need to undertake procedures which will affect which will help us to identify the non-compliance of the rules and regulation. Now, one thing that you need to understand is that the auditor has no formal responsibility of NOCLAR. They have no formal responsibility of the NOCLAR, but should respond appropriately if any non-compliance is being identified. So they are not formally responsible for NOCLAR. Like if they identify a NOCLAR, the standard does not require what they are supposed to do, but they have to respond to them appropriately if they find such cases. Like they should not help the client. One simple thing is that the auditor should not help the client to say, oh, you know what, this is a non-compliance, I will help you to conceal them. You cannot do that. You cannot do that. You need to definitely discourage the client from non-compliance. Certain examples of laws and regulation that may have direct or a material effect. So some could have a direct effect or some could have a material effect are these ones. Definitely money laundering and other financial crime could have a direct and material effect, because it is for certain kind of industry, financial institution. For example, financial institution, money laundering will have a direct effect, because as per the AML procedures, certain standards or provisions are required by the AML activities to mention it in the financial statement. Environment and public safety could have a material effect, because there could be huge fines and penalties if the company is not following it, and the huge fines and penalties, the company will try to conceal the information. Fraud, corruption or bribery could also have direct or material effect. Data protection, like the entity should maintain the data, should not leak the data of the employees, etc. All those things also are required to protect and ensure that these effects does not happen again and again. And also Companies Act, taxation have a direct effect. So these laws and regulations might not have a direct effect or could have a material effect or a direct effect depending upon the company to company. So in order to determine whether NOCLAR has been occurred, what does the auditor will do? Firstly, he tries to obtain a general understanding of the legal and regulatory framework within which the company is working. Like AML. Like when we are auditing a bank, the first thing we ask is, do you have an AML procedure? Give us the procedure document. If the bank does not have an AML procedure document, definitely that is a non-compliance. They are required to have it as per the anti-money laundering requirements and rules and regulations, and as per the FATF provisions, every bank, financial institution should have an AML procedure document. If they are not having it, it doesn't definitely is a direct evidence stating that they are non-compliant with the rules and regulation. To ensure that whether the client is complying with certain laws and regulation which have a direct effect, we try to set up certain direct procedures like inquiring, reviewing certain documents. Like for example, taxation. We will ask them for tax returns that have been filed in the previous years. We can ask for the tax payment details that have been paid over the last few years. Companies Act provisions. Auditors are required to learn the Companies Act provisions and see if they are in compliance in the financial statement. If that's not, then it is required that the auditors suggest and clearly recommend to the client that they are not following the Companies Act, etc. So auditors, what do? Is they create certain procedures when a possible NOCLAR is detected. So if they detect a possible NOCLAR, then they create a step of procedures to help them identify if there is any non-compliance, or they create certain certain kind of audit procedures which help them to identify these kind of non-compliance related issues. So ISA 250 sets out certain examples or type of information that can come to the auditor's attention that may indicate non-compliance. So the below ones are these ones are the list of indications in a company which could say that there could be a non-compliance. So these are indicators to non-compliance. Example are investigations by a regulatory organization or government department or payment of fines or penalties. Like the company is paying fines or penalties frequently in their financial statements or in their transactions or in the bank statement, it is evident, or the government regulations are coming and investigating them quite frequently. Payment for unspecified services like loans to consultant, like they are saying, oh, you know what, they are not able to give us the engagement letter of a consultant, but they are saying, okay, loans to consultant. Related party, certain payments that is gone, certain payments to government employees, etc. Sales commissions, major companies actually put these bribes as part of sales commissions to certain agents. So it's an agent, but that technically it will be a bribe. Purchasing at prices significantly above the market price or below the market price, right? So that they can mask the certain pricing factors as well, and they would put it as a significantly higher price so that the bribe amount would also be included there. Unusual payments in cash in purchases in the form of cashier checks payable. So frequent cash payments are being going out or cash purchases are being going out. Unusual transactions with companies in tax haven. Although it is not illegal for companies to have one of their office or a branch or even a registered office or parent company in a tax haven. To give you an example is Apple company. You know that Apple company's parent company is in a tax haven. If I'm not wrong, it is in Bermudas and Bahamas. And there is like billions of dollars of dividends that this parent company are unable to give it to the company in US. So it is not illegal to have shell companies in tax havens or registered companies in tax havens, but if they do not have such company, then there could be cases where the companies in a taxable environment does frequent transactions with companies in tax which are in tax havens. That could potentially possibly indicate certain non-compliance related areas or items. Payments of goods and services made more than to country from which the goods and services are originated. Like you are trying to mask the transactions, or you don't want to sell off the goods so that you don't want to show certain kind of income or anything. So you try to make transactions in such a way that the goods and services are made other than the country from they originated, like they're coming from some other country, so that if you buy from this country, taxation will be less, so you have tax treaty on those. So those are all illegal things that the companies try to do. Payments without proper exchange control documentations, like you're making a payment but you don't have any exchange documentation. Existence of an information system that fails, whether by design or accident, to provide an adequate audit trail. Like when we ask for certain documents or information relating to certain payments, they'll say, oh, you know what, the system is not operating well. during that time the system was not functioning, or during this time the system was down, etc. So we lost the audit track. Unauthorized transactions to improperly recorded transactions. So it is very difficult to mask certain red flag amounts. Like if it is a huge amount, it's very difficult to mask them. So sometimes the accountants, they try to give random numbers or names to those transactions, which would caught as a red flag. Adverse media comment, like media comes up and says that there is some issue with the company. To give you a very simple example is what happened in this year in 2023 with respect to Hindenburg report. So Hindenburg was a company that actually came up with a report as an allegation against the Adani Enterprises. And they gave a huge report stating that the Adani Enterprises have a lot of tax havens, they do a lot of mishandlings. It's a primary concern which are not audited well. It's like a small company which is auditing them. A lot of allegations they came up with. This could potentially indicate that they are non-compliant or they are not following the rules and regulations clearly, and now auditors will start would have started scrutinizing, like government regulations. Auditors, everybody will be scrutinizing and having extra pair of eyes on these Adani Enterprises. Even Byju's, for that matter, what happened is like Deloitte resigned. Deloitte would have considered a lot of allegations against them, like defaulting loan payments, having FEMA violations, and because of which government actually the national agency NIA actually investigated into the offices of the Byju's, raided the office of the Byju's and the home of the Byju company, the CEO of the Byju's, to check whether there are any violations in fact. And all those media comments actually will affect the mindsets of the auditor, and those kinds of raids etc. would have actually considered for the fact that Deloitte would have resigned considering these facts as well, because they are in the limelight, and auditors do not want the limelight because that will affect their their entity's opinion as well. So with respect to that, when it comes to non-compliance, there are few considerations. So these are considerations the auditors are required to consider. So these are few considerations that auditor have to take a look at. Like, what are the potential breach of the transactions? Like, what are they trying to breach? What are the consequences of the breach? Are they fines, penalties, damages, threats of expropriation of assets? Like, if there are certain breaches, then your assets will be freezed by the government. They could freeze your assets, they could freeze your bank accounts, etc. Enforce the discontinuation of operations and litigations. Like your business could be closed down. So what are the potential consequence? Like, what is the potential consequence? If it's a financial consequence, what is the consequence? If it is other financial, if it is not a financial consequence, is it an operational consequence? Of course, operational consequence like termination, suspension, etc. of your business and license could affect financially for the company as well. Whether the consequence require a disclosure in financial statement. So if there is a non-compliance, then that has to be disclosed in the financial statement. Because I remember clearly is that we looked at all the fines and penalties that the bank had incurred, and we were checking what the fines and penalties were for. And as per the contingent liability provision, IAS 37 says potential liability, we can recognize, right, as part of the contingent liability and disclose it. So we did disclose those potential fines and penalties. We summarized it. We created a table that the bank had recently got the fines and penalties, and these are the fines and penalties. So we said that, okay, you know what, these are the existing fines and penalties. There could be future potential impact as well. So that also we disclosed in the financial statements. Whether the potential financial consequences are so serious as to call into question the fair presentation given by the financial statement, or otherwise make the financial statement misleading, right? So if the potential financial statements are so serious that whether it could affect the true and fair view of the financial statement, like for example, their business could close down and the company have to mention the fact that they might not be a going concern. But the company is saying that no, I don't care about this legal side. I would mention it only as a going concern. That is actually a true and non-true and fair position. So we have to consider that seriousness into the action, because these laws and regulations could affect the going concern of the entity. So in terms of the procedure, what the auditors follow as a procedure with respect to the NOCLAR. So firstly, document all the findings along with supported evidences for the in relation to the NOCLAR. Like all the documents in relation to the NOCLAR have to be documented, and the findings have to be noted down. Discuss with the management, and also take the written representation from the management in relation to the NOCLAR, that this is a NOCLAR event and they are aware of this NOCLAR, etc., so that you protect yourself. Consult with the entity's lawyer, like understand from the entity's lawyer, is there any potential breach of laws and regulations, whether there could be further potential breach of litigations could affect the company, in what way they could affect, what will be the financial implications, etc. When it comes to written representation, we need to get a specific line also that which confirms that the management, as per their awareness, is they are complying with all the necessary laws and regulations, and they have strict rules and regulations in respect to prevention and detection of NOCLAR, prevention and detection of compliance in relation to the laws and regulations. So that also we can get in a line in the written representation and get it signed from the management. Reassess the risk. Identify the risk that could potentially affect in relation to the non-compliance, like taxation, not filing the returns properly could be a risk, going concern could be a risk, potential fines and penalties could be a risk, etc. So identify the risk, assess the risk, and identify the risk in relation to the non-compliance. And also, auditors are also responsible to do a communication. So the auditor should communicate all the matters with respect to the NOCLAR to those charged with governance. Like all the matters have to be communicated. In fact, the ACCA 250 also states that if there is any non-compliant, the auditor should discourage from those charged with governance and management in those aspects. But ACCA 250 also suggests that don't ensure that you are not tipping off the client. Ensure that you're not tipping off with the client. Like prohibit communicating to those charged with governance if they suspect the management or those charged with governance in relation to certain serious laws and regulations like money laundering. So if you are suspecting the management is doing certain deliberate non-compliance, like not unintentional, there could be unintentional issues as well. They would not have been aware of it and they went for a non-compliance. But if there are deliberate actions, that shows for a suspicion. If there is a suspicion, then prohibit from communicating to those charged with governance, report it to the concerned authority. In extreme cases, if the non-compliance is so severe, you can compel the management to do some disclosures as part of the public interest. You can also, ensure that you come out and follow the confidentiality agreement, but speak out in terms of the non-compliance as well to the relevant authorities or regulatory board of the auditor. Like for example, they can consider for a legal action, like auditors can consider for a legal action against the client themselves. They can go to the court of law and also submit to the government agencies relating to the non-compliance done by the entities. But they have to maintain their ethical duty of confidentiality. So keeping their ethical duty of confidentiality in the mind, they need to come out and speak with the relevant channels and with the relevant communication mode if an entity is doing a non-compliance. And of course, one red flag that will put off against the non-compliance to their shareholders is definitely a withdrawal. And auditors can consider if the entity is not taking any remedial action, if they are not fulfilling the duties properly, if they are still doing a lot of non-compliance related activity, then the auditor can consider withdrawal. But definitely it's a last resort. It should be a last resort. It might not be like, directly responding to a non-compliance, but they can consider withdrawing to protect themselves. There have been instances where, certain, to give an example itself, certain auditors would resign from the services of a company which are doing bribery or fraudulent related activities with certain people, and even after a lot of discouragement to the management and ensuring that they fulfill the duties very clearly, auditors failed to help the management in any sort of way, and the management is not again complying to the laws and regulations. They keep on doing whatever they are trying to do, and in that case you can consider withdrawing from the client as a last resort. So before you withdraw, few things have to be summarized by the auditor is obtain a general understanding of the legal and regulatory framework, like how severe the non-compliance is. If you discovered certain non-compliance, obtain further understanding of it. Firstly, understand in which legal and regulatory framework the client is working in. Like as an auditor, you are required to know what are the legal provisions and regulations that affect the client. Second is, you need to have a general understanding. You don't need to have full understanding because you are not a lawyer, you are just an auditor. But you need to have a general understanding. Second is, if NOCLAR is discovered, if you identify a NOCLAR, you obtain further details with respect to the NOCLAR. Evaluate the impact of NOCLAR on the financial statement. Like how does the NOCLAR affect the financial statement? Report to the necessary level of management, like those charged with governance, etc. Report them to the management. And then still if there is issues, consider withdrawal. If there is still issues and the management is not willing to cooperate, consider withdrawal. So withdrawal from the engagement is also a resort to fight the NOCLAR. Another way is to modify the opinion. Like the auditor report identifies that due to non-compliance, there is material misstatement, like there are certain fines and penalties which the entity have paid, but the entity is not reporting that in the financial statement. So that shows clear misstatement, like entity paid a fine or penalty for environmental damages, but they are not willing to show it as a fine or penalty in the financial statement. They showed it as something else. That is clear misstatement. Now, in that case, depending upon the materiality and whether the misstatement is pervasive or not, you can issue either a qualified or an adverse opinion. If it is material, definitely you will material misstatement, definitely you will issue or express a qualified opinion. If it is an adverse opinion, you will issue an adverse opinion when it is material as well as pervasive. But you don't have any evidence. There are certain transaction that goes to the government, someone, and you asked for evidence like what is this transaction for? Give us supporting evidences, but the client is not giving us. So now you don't know whether it is a compliance related area or non-compliance. So you don't know. So if that's the case, then you issue again qualified opinion or again disclaimer of opinion. So that is another way to tackle the NOCLAR with the client. So that's about the NOCLAR, and with this we have completed this chapter. We will next move on to the second chapter.